Aruna, are we sort of good to start? It's about 4, no?
Raji, we are live now, so you can switch off your video and mute your camera.
Okay.
Hi, Anura, we are here.
Okay, good.
Sorry for the delay.
Very good afternoon to you for those who have logged in to our webinar today on the theme Finance in Digital Transformation is going public, the next step. I'm sure today's session is going to be a very valuable session for all the tech companies who have given the support during the lockdown, making most of our companies digital. So in that context, we felt that this topic is very important for look at tech companies, how they can go public. Today's session is organized by FITIS, Federation of Information Technology Industry Sri Lanka, in association with Colombo Stock Exchange and ICTA. Today, our event partner is IBM Reddington. And also I would like to mention our other partners, Tech Labs, our messaging partner, TextWay, print media partner, Daily FT. Also today's event is supported by ACCA, CIMA, Computer Society of Sri Lanka, ICTA, our supporting partner. Also, I would like to mention our corporate partners, Asiata Digital Labs, Just in Time, Lanka Bell, LK Domain, Luna Labs, Orel IT, Sarva, Zillion. So on behalf of FITIS, I would like to thank them for their support extended today. Let me also mention our eminent panel of speakers today who have given their time and contributing to this particular topic today. We have, in terms of the speakers, we have Mr. Rajiva Bandaranayake, Chief Executive Officer of Colombo Stock Exchange. Following Rajiva, we will have Renuka Vijayawardena, Chief Regulatory Officer, Colombo Stock Exchange. Following Renuka, we will have Nilendra Veerasinghe, Head of Corporate Advisory, NDB Investment Bank. And then finally, we will have Jeffrey Zulfa, founder and the CEO of Pygmy. We also have with us Mr. Abbas Kamuddin, Chairman FITIS and also Managing Director of Debug Group of Companies. Also with us, Mr. Jayantha Fernando, Director ICTA, and also the board member of Colombo Stock Exchange and the chairman of LK Domain Registry, who in fact initiated this program, and we thank Jayantha also joining with us today. So with that introduction, I would like to ask Mr. Abbas Kamuddin to formally welcome and then start the session. Abbas, over to you.
Thank you, Aruna. And on behalf of the Federation of IT Industry Sri Lanka, let me welcome all of you today to today's very important forum that we're having today, namely financing digital transformation is going public, the next step. I believe it's a subject that is very close to the heart of the industry. One of the key challenges that the industry is facing on top of the element of human resources. Other than the challenge of human resources that the industry is having in terms of getting more people to come into the industry, I think the second most challenging element of the industry is financing, access to financing for the companies, especially that are into intellectual property development and product development. So with that, let me first of all just quickly introduce FITIS, Federation of IT Industry Sri Lanka is the apex body for the ICT industry of Sri Lanka. There are many chapters which represent all the elements within the ICT sector. We've got the hardware chapter which represents all the hardware vendors and the system integrators. We've got the software chapter which represents all the software companies within Sri Lanka. We've got the communication chapter which represents all the telcos and other communication related services. We've got the professional chapter which represents all the professionals within the industry. We've got the education and training chapter which represents all the education and training companies that teach ICT. And we have got, most importantly, we've got two new chapters within the federation, one being the office automation chapter and the other being the digital platforms chapter, the digital services chapter, which provide various digital services using technology as its platform. So that is a quick brief about FITIS. Our two key mandates that we are driven by, one being driving digital transformation within Sri Lanka to move Sri Lanka towards a digital economy, and the second being driving intellectual property development within Sri Lanka to ensure that Sri Lanka can be positioned in the future as a technology hub or a digital hub. So these are the two key mandates that we are driven by, and one of the key elements to achieve our two mandates is ensuring that the necessary funding and the financing is available for the industry to be able to expand and to grow, to address the requirements and the needs that are going to come out of the economy. So with that, saying that, I would like to also say that there are many forms of sources of funding that we have, from bootstrapping to private equity to various different debt capital available to investors, to venture capitalists. But personally, I believe that the one true method that has stood its test of time has been going public and essentially financing through public investors. So with that, I'm sure that there are many misconceptions as well with regards to this. I'm sure our elite panelists today will be addressing a lot of the misconceptions. And I truly believe that at the end of this session, a number of our audience today will be very keen on looking at how to take the next step. And for those of you who are ready to invest, who are ready to take the next step in going public, we would like to hear from you. We would like to know who of you is interested to move on to our next stage. This is our first stage, to see who's interested in joining us on this journey towards going public. And any company that's interested in moving towards the next stage, we would like to know from you. We would like to hear from you. Please write to FITIS, and we will then enroll you as part of our next phase of going public to see how we could help you with guidance, with support, and with one-to-one meetings to help you to move towards the next step. So that's the next plan, and that's the next stage of our process. So with that, let us go, without further ado, let us go into the nitty-gritty of it and the details of it. And I'm sure the elite panelists today will do justice to it. With that, I would like to thank you all once again and hand it over back to Aruna. Aruna, over to you.
Yes. Thank you, Abbas, for that introduction. So with that, may I ask Jayanta to make your remarks on behalf of ICTA. Jayanta, over to you.
Yeah, Aruna, can I be heard?
Yes, can.
Yeah.
Please go ahead.
Thank you, Aruna and Abbas. It's really nice once again to be part of this joint FITIS and ICTA-led program in close collaboration with Colombo Stock Exchange. This is also one of these one of our long outstanding strategies that we have been trying to nurture for a period of years. But I am delighted that with the new leadership of the board of directors of ICTA, mainly through the support we are getting from Mr. Jayanta De Silva. And by the way, I'm Jayanta Fernando. Many people confuse the two of us. Jayanta De Silva has been an eminent figure in the industry and been at the forefront of driving transformations, digital transformations through the private sector and helping the country ecosystem grow in a rapid manner. They have taken a lot of steps. The new board has taken a lot of steps to develop partnerships. And one of the key partnerships that have evolved in recent times is the one that we have developed with the Colombo Stock Exchange. And I serve on the board of the Colombo Stock Exchange, and that provides an interface that has necessarily would create a long-standing partnership to help the entire sector grow to the next level. So this is a great initiative put together by FITIS, the Colombo Stock Exchange and ICTA, bringing all the experts on capital raising through the stock market to one forum to discuss available opportunities and avenues that can be used by companies, especially the tech companies in the country, to spur and enable them to grow to the next level. In recent times, there have been international news media mentioning many times. I think there was a program even on CNN which mentioned that tech IPOs are heating up around the world, and I believe that recent introductions which will be discussed today to facilitate a new wave of companies, especially tech companies, would be coming at the right time. This is the best opportunity for tech companies to enter the capital market ecosystem, to raise funds, raise capital, to move to the next level. Given the current COVID outbreak and the changes taking place around the world, companies operating within the technology space are bound to thrive, being at the forefront of that which is now considered to be the new norm, and are most certainly going to require additional funding to benefit from this available opportunity. We have seen many renowned global brands that have talked about going public for some time and receiving enthusiastic receptions. And since of late, it has been tech company IPOs that have made the loudest noise coming in and still remain on top of the IPO leaderboards. This has led to high valued companies that were normally content through private markets to take the leap of going public. Of course, there are additional coming obligations that you have to that is entailed when you go public, and I think today's presenters will enlighten you about the obligations that you have to undertake when a company goes public. The global success stories that have helped catalyze a shift among private company leadership towards viewing public markets as a more welcoming place to raise capital. The stock market engine should be recognized as a tool within this ecosystem, if correctly used, could pave the way for companies to grow. And not only the companies, it will also help the economy to grow to the next level as well. So taking a company public would result in an array of benefits available to a company, and I'm sure this will be enlightened by speakers like Rajiva as well as Renuka and others. And we will see the benefits also flowing to the wider community by offering wider community participation in this ecosystem, which will help tackle income disparity as well. And of course, we know that this is not high up in the minds and the agendas of CEOs, but it is an important point that will hopefully resonate more as the current trend and its benefits become clearer, which indeed will help Sri Lanka prosper. I believe that this discussion would provide all of you with the required insights to explore a public listing to get started on the process now or in the near future, and ready to come on board as we move towards a more listed, conducive market. And I am sure our friends from Colombo Stock Exchange will explain the amendments to the rules that have made the entry to tech companies much easier than before. In conclusion, I just want to enlighten about the ICTA collaboration in recent times with the Colombo Stock Exchange. With the appointment of Dumit Fernando as chairman of the Colombo Stock Exchange, there was a discussion that we arranged between Dumit and Jayantha De Silva, which led to a wider discussion about long-term collaboration between government as well as Colombo Stock Exchange, not only to broad base the listing, but also to ensure that tech companies become educated to get into the ecosystem. So ICTA in that context has also been participating in this collaboration in a serious manner, and we support the joint SEC Colombo Stock Exchange initiative to fast track the digitization initiative that will be announced in the near future. A lot of work has happened in that connection, including the eKYC solution that will facilitate digital onboarding of customers to the CDS. With that note, I thank you, and I wish the session all the very best. Thank you.
Thank you, Jayant, sharing those insights. I'm sure those are very useful insights. So with that, I would like to invite Rajiva Bandaranayake, Chief Executive Officer of Colombo Stock Exchange, to enlighten us on listing on the CSE, the benefits of listing and the misconceptions. Over to you, Rajiv.
Thank you and good afternoon. If it is Crystal can share the presentation, I can tell you when to change the slides. Good afternoon to all of you, and first of all, I would like to thank both FITIS and ICTA for putting this session together, particularly Aruna and of course Abbas from FITIS, and also from ICTA, Jayanta and Sachindra for doing all the background work to make this happen today. And also to thank Nilendra and Zulfa for joining Renuk and me today at this session. So as Jayanta did mention, we're happy to announce that the CSC has worked out a framework within which tech sector companies can access public markets. And if you can do change the slide, please. Yeah. And over the next 45 minutes or so, what we'll try to do is to describe this opportunity in greater detail. We all know that the IT industry is one of the identified growth sectors in the economy, a sector that has seen, I think, about a 120% growth in the last 5 years, has over maybe 600 IT-based companies operating, employing well over maybe 200,000 professionals or so, and also has become Sri Lanka's 4th largest export earner. But sadly, this sector is grossly underrepresented, or I would even say not represented directly in the Colombo stock market. So we conducted a research among peer stock exchanges globally, among tech companies, investment banks, and others in the industry, and identified certain pain points which clearly acted as barriers for tech companies to reach out to a public market like the stock market. What we did find, amongst some other reasons, is that the 3-year profitability criteria for a main board listing and the positive net assets for a Dirisavi board listing were 2 of the main pain points. So what we did was to develop alternative methods by which companies could list, and we came up with a criteria of adopting 3 other alternative tests for the main board and 2 other alternative tests for the Dirisavi board that companies could use to qualify for a listing, thereby throwing wide open the doors for tech companies to enter the listed space. And we will discuss these as we go along today. So if you can change the slide, please. Yeah. So if you look at typically, one more change, please. Yes. Okay, one more change on the slide. The next slide. Yeah, okay, that's fine. So if you look at a typical tech company, there's a process that a company would go through from a concept stage where you would use your own funds to a startup phase where you will reach out to an angel investor, for example, or a venture capitalist, and then on to a growth phase where you will likely attract private equity. And then finally, you are ready to take the plunge to go public. So typically, companies may need to go public when your venture capitalist or your angel investor or your private equity firm needs to exit that investment. Then the public market becomes the optimum choice to do that. Your investors will like the idea of a market-based exit, and therefore if you do have a plan for a public listing someday, your company would be in a better position to attract an investor at an early stage that will help your company to grow and also nurture your growth. If you get to the next slide, please. These slides will show you some of the success stories around the world. And if you look at most markets globally, and you will find that tech companies account for a significant portion of the listed space in any market, as you can see from there, at a minimum 10% or more. And you can also see some of the more successful IPOs or larger tech companies like, for example, Amazon, Uber, Alibaba, etc. So we are hoping to attract the Sri Lankan equivalents that we have, companies that we have over here. Okay, so change of slide, please. This what I will do is to maybe skip this slide because we'll take this part of it during question times and we can probably elaborate this better. So if I can get on again, slip this slide as well, we'll take this at question time. In the interest of time, we will take it at question time. If I go very quickly to talk about some of the benefits and the common misperceptions on listings, before I hand over to Renuka to talk about the changes that we have done to enable tech companies like yours to come in. Primarily, owners of companies can realize the true potential of a business by unlocking the value of your company you built by taking it public and listing the company, and then having a market price established for the shares of your company. By taking it public, you will find that a market price for your company will be established, leading to wealth creation for shareholders. One of the key functions of a stock market is this process of price discovery, where a price for your share will be discovered through a public listing. That appreciation of the share price is what will create wealth for shareholders. Even if you look at the vision statement of the stock exchange, we talk of creating wealth and value. So stock markets are all about creating wealth for shareholders, and we will discuss this as we go on a little later. Now, there are many examples of companies which listed and created instant wealth for its shareholders as a result of the listing. So listing is an exciting choice. Why? Why? Because wealth creation is exciting for anyone. Of course, there are many other benefits apart from this price discovery process. For example, a listing provides an opportunity for a company to achieve an optimum capital structure. You could choose to retire some expensive debt, for example, by converting debt to equity capital. Needless to say, once listed, it will also enhance your corporate visibility, enhance your image as a good corporate citizen, and ultimately even result in your brand getting stronger and better recognition. A listing will also help you to improve your governance and accountability as well. Then, employee share option schemes is another powerful tool to acquire good talent, and by giving your engineers a stake in the company, they can encash it through a publicly traded market and will be a good carrot to attract and retain these critical staff. Another advantage that I can mention today is about the fact that companies once listed can keep coming back to the market to fund further growth, to fund your next growth phase or further growth of your company. Then finally, as another benefit, you can also consider the fact that a listing will facilitate mergers and acquisitions. At some point of the life cycle of your company, this can also be a very strong advantage. So let me also, if I can get to the next slide, please. I can talk about some of the commonly held misconceptions or misperceptions that we have heard with regard to a listing. Now, there are many. The first one that we hear very often is about loss of control. Now, this is a fairly unfounded concern, if I may put it that way, as the public holding requirement as a continuous basis is only 20% at a maximum, leaving promoters with a comfortable 80% control. All you need, in fact, is a 51% of the shares of the company to control the company. You need not therefore hold on to 80% to control the company. And in fact, you can even make the wise choice of encashing some of your wealth by disposing part of your holding while retaining a comfortable majority control. So it's in effect having the cake and eating it as well. So the fact about loss of control will arise only if you try to control the company by maybe having about a 10% stake, which will then leave you open for others to come and take over a company in the event a company is publicly listed. So this is one of the first concerns that some company owners have expressed. Then another common concern is about paying dividends. Paying an annual dividend or some dividends during the year is not a requirement. There is no rule to say by the stock exchange or the regulator that companies are compelled to pay dividends. Of course, if you have raised money from the public, there will be a reasonable expectation of some form of returns by those who have invested in your company. So perhaps you have a moral and ethical obligation to offer a return to shareholders. Then only your share price will perform and of course create wealth for you. But other than dividends, you can give shareholders returns by way of, for example, capital gains through an appreciation of share prices. And some companies, especially tech companies in the growth phase, may choose to offer returns to shareholder by way of capital gains through price appreciation as opposed to a cash dividend, as you want to reinvest the profits of your company in the business rather than pay out the earnings to shareholders. But here, you must ensure that then shareholders can profit through a share price appreciation. So your company, if it does well, if there is growth and there is share price appreciation, there's a demand created for your shares, then shareholders will get that return instead of dividend through a capital gain. Another fear that you may have or a concern that you may have is to divulge too many things about your business, giving an unfair advantage to your competitors who may be unlisted. But what needs to be disclosed is very clearly set out in the listing rules, and these disclosures are not to tell you to disclose business secrets. The objective test is that only if a piece of information is material to the share price of that company, then a disclosure is required. And that materiality has to be decided by the board of directors of that company. The materiality is determined by the company directors themselves, and the CSC will not sit on judgment as to what disclosures a company has to make. Of course, common instances where a public disclosure is required, like for example, a decision to pay a dividend must immediately be disclosed, and there is no test of materiality in those instances, but those instances are fairly clear and laid out in the listing rules, so that you know upfront what exactly should be done. Then finally, there is this concern that the listing process is complex and time consuming. At the outset itself, I think I can rebut this concern, and we are here to tell you that it's not. The listing rules very clearly articulate what is expected. Investment banks are there to guide you, and our team led by Renuka is ever willing to handhold your company through the entire process, to guide you, to assist you, to make this listing experience a pleasant and of course importantly a rewarding one. I think with that I will stop here and then hand over to Renuka to continue with an important aspect of what the changes we have done to facilitate these tech companies to enter public markets. Renuka, I think over to you.
Yes, thank you, Raju. Aruna, am I?
Yes, yes,
okay.
Please go ahead. We are pleased to listen from you about the pleasing journey which Rajiv explained. Everyone would like to know, and I think Rajiva's presentation thank for enlightening everyone on the benefits and also the misconception. I think that give a lot of boost to all the tech companies who are interested in listing. So next part is yours. I think we look forward to your presentation. Renuka, please go ahead. Yes.
Okay, thank you very much again for inviting us. I think I have a couple of slides. If I can get the first slide. In the interest of time, I'll initially limit my presentation only to describe the new listing criteria. So if I can get that slide on the screen, I have 3 slides, I think. Anybody? It's a continuation of Rajiv's presentation, actually. Aruna?
Just give a second, Renuka, yes.
Yeah. Yes, that's right. Now, tradition of how we have structured our listing framework is basically we have a main listing segment and an alternate listing segment. Now, in the main listing segment, we have 2 boards, main board and the Dirisavi board. So traditionally, that's what we have done. But now we changed this over a long period. But we have not really looked at the listing criteria applicable to these 2 boards. As you can see on your screen, now to list a company on the main board, you have to have a minimum stated capital and certain level of public holding. So that's a must. Actually, those 2 criteria we have not changed. Same applies to Dirisavi. Now, what we have changed is basically in relation to adding up new types of criteria. Now, according to the old rules, we spoke of having net profit. If you want to list on the main board, you have to have a 3-year consecutive profit record. Otherwise, you can't list on the main board, however good you are. Then there was also another rule on positive net assets. As per the consolidated accounts, audited financial statements, last 2 years financial statements should basically have positive net assets. That's for the main board. Now we have expanded on this criteria. I'll come to that later. So Dirisavi also pretty much it was the same case. We had the public float rule, we had the stated capital rule. In addition to that, there was a rule about having 1 year's operation history and also having positive net assets as per the last financial year's audited accounts. Now, the old criteria did not take into consideration certain aspects like revenue that can be generated by the company or the cash flows. Now we looked at, there were various reasons for us to do it. I think Rajiv explained one reason, tech companies, yes, startups, yes, and also the new businesses that are emerging. Now world is changing, right? We can't stick to these rigid rules. We are ever willing to change according to the business dynamics of the country. There are lots of new business models which are coming up. Technology-based companies, right-hand sharing, all kinds of companies are coming up, startups. And we looked at, as we always do, we looked at the listing criteria of other markets. Now we realized that other markets have thrown up new types of criteria. Now, if I can go to the next slide, I can explain about the new criteria that we introduced from this year, around about March. There it is. Now, one major change that we did was for the main board, we have said that earlier that it has to be a 3-year profit record. Now we included another criteria. So there are 3 tests we are talking about here. First one is on the profit test. Now, in terms of the profit test, you have to have a 3-year profit record or a aggregate net profit. Now, earlier aggregate net profit was not considered. So there's a new option that is given under the new rules. So you have to have either of those. That means you have to either have 3-year consecutive profit record or aggregate net profit record for the last 3 years plus positive net assets. So that's one criteria. Positive net assets as per the last 2 financial years audited accounts. So that's the profit and net asset test. So that's one option. Second option is the new one of the new ones, a new criteria, revenue and market capitalization based test. Now, if the company has an aggregate revenue of more than 3 billion rupees as per the audited accounts, you could apply for a listing on the main board, but you have to have a market cap of 5 billion. Both conditions should be met if you opt for the second test, because it takes into consideration the size of the company as well as the fact that company generates sufficient revenue. That's the second test. So these are all optional. Third one is based on the cash flow. Now there we have not given a number. So if a applicant company opts for this criteria, they have to demonstrate that there is positive operating cash flows after adjustment for working capital, etc. during the last 2 financial years, plus that market cap requirement of 5 billion. So that is one of the changes that we did for the main board. Now, add to that, we have also brought in another new rule, which is about the independent auditor's report not containing an emphasis of matter on going concern. So that basically that's a qualitative element that brings out a qualitative element to the financial statements of the company. So those are the new criteria that we have adopted from this year for main board listing. For Dirisavi board listing also, we have brought in the revenue criteria, which goes as this. The revenue is based on the last financial year actually. So the applicant company has to show 350 million rupees as revenue based on the last financial year, as demonstrated in the audit accounts, plus a market cap of 2 billion rupees. So that's one of the tests. Or alternatively, they can show the positive net assets. So as per the positive net assets test, the Dirisavi board applicant company has to show that the company has positive net assets for the financial year, which is immediately preceding the date of the listing application. So those are the new criteria that were brought in for Dirisavi. Of course, we have also included the emphasis of matter, not the audited accounts not containing an emphasis of matter on going concerns. That we have retained. So those are the new listing criteria that we have added. We have kept the public float as it is. Public float requirements are not changed, and the minimum stated capital requirements are also not changed. Now this is for the main board and Dirisavi board. I will stop at this because there are so many other changes that we have done in terms of the listing process, in terms of basis of allotment, the disclosure that go into the prospectus. We have made it very flexible. Maybe as we go along, we can discuss those. Thank you.
Thank you, Renuka, for enlightening us on these recent changes. So with that, I would like to move on to Nilendra Veerasinghe, Head of Corporate Advisory at NDB. I think it is the bank who's playing the in between the CSC and the company. So Nilendra, I'm sure you have a bigger role to play to talk about the role that the bank would play in terms of any company going to be listed. So with that, I would request Nilendra to start your presentation.
Thanks, Aruna, and a big thank you to FITIS, ICTA, Colombo Stock Exchange for putting this panel and webinar together. And it gives me immense pleasure to be on this panel, especially talking about something that essentially marries my professional training with my education, which is in the technology space. So let me quickly bring up the slides. Okay, so I'll quickly start off with a graph that Rajiv alluded to in his presentation. And why I bring this up is to look at it from a slightly different perspective. Because if you look at a venture's usual, and I place additional emphasis on the word usual, the usual funding life cycle from ideation, which is essentially self-funded, to early stage angel-driven. Then you have VC, additional VC rounds, PE, and then culminating to an IPO. Now, why we have this usual trend is that across the different stages, you see differences in risk-reward structure. Starting on the left, where risk rewards are extremely high, towards the right, which is the IPO end of the spectrum, where it will be more market-driven risk-return objectives and preferences. And also throughout this spectrum from left to right, you basically would have your level of involvement or value addition from that external investor changing dramatically. From an angel investor who will get involved on a weekly, if not daily basis, to VC, PE, right up to IPO, where probably your public investors would hear from you once a quarter via a quarterly communication and probably see you in person annually at an annual general meeting. So essentially, this growth path has different risk reward parameters and also different levels of involvement. Now, if you really look at why tech companies go public, I've managed to kind of summarize all the various reasons that you might see out there to three main points. Firstly, there is a need for liquidity to facilitate investor exits. And that's coming from the life cycle that I mentioned. You have so many external shareholders and stakeholders that are partnering with you on that process, and they need to see their gains. They need to monetize their investments, or even if they're not selling, at least see liquidity that they can monetize when they need. Secondly, you have the enhanced credibility that comes from a listing. Yes, you remain to be a legal entity, veil of incorporation, whether you're listed or unlisted, but by being a listed entity, by virtue of the additional regulatory oversight that comes with it, there is a definite perceived enhancement in the level of credibility when it comes to dealing with minority public investors, banks, lenders, creditors, suppliers. This credibility enhancement benefit really comes into play. And then thirdly, of course, the most important thing, to raise capital, either to expand into what is being done or finance operations. Now, these 3 points might seem obvious when it comes to any company or rationale for any company to go public. But I would say in the tech space, apart from raising capital itself, the first 2 points feature high in some of these large popular listings that we tend to be familiar with. So the point being, raising capital is not the only rationale behind IPOs, and this is very much felt in the technology space. Just to give you an example, Huawei, when it was caught in the middle of the US-China tech tug-of-war, one of the criticisms among many was that Huawei's ownership structure wasn't clear. Who is the ultimate beneficiary owner wasn't clear. It's not listed. And I'm picking on that word, it's not listed, meaning being listed implies credibility, gives that transparency, and is perceived well by regulatory and international governments. Okay, so no analysis will be complete without digging up on some data. So I've digged up on last 4 decades of tech IPOs from the US market. Now, not to say that the US market is something that we can compare directly and apply those metrics, those yardsticks here. But having such a large set of data, about 3,160 IPOs over the last 4 decades in the tech sector, will tell us or help us infer some of the trends, some of the underlying investor behavior and issuer behavior that will hopefully let us learn and improve things here. So there's a lot of graphs on your screen, but let me draw your attention firstly to the light blue bar graph right at the bottom. So basically, if you look at it from the 80s right up to 2019, which this covers in the last bar, the median age that a company takes since founding, since establishment to go public, from about 5 over the years, over 40 years, have changed to about 10 or even slightly more than 10. Median as of 2019 being about 12. Similarly, I would like to then draw your attention to the orange line over here. That's the percentage of companies that are VC backed, venture capital backed. Starting from roughly about 40s, 50s, and even lower, even 30%, you see a average overall trend where last couple of years, last 5 to 7 years, have been in the range of 70 to 80%. So 70 to 80% of these tech IPOs have been VC backed. Now, we may not have a VC industry that is as vibrant or nowhere near vibrant as in that part of the world, but at least there has been 23% of companies that have not been VC backed, and let's look at how they have gone public, because we can always talk about the VCP industries. We have the ecosystem now forming. There is angel investments, there are seed level options of funding available, there are some private equity funds, there is a little bit of VC space being formulated. This will take time, but until that happens to an extent where our entrepreneurs, our startups have ample funding out there, we may have to find alternatives. Now, these alternatives, I think, mainly would be threefold. Firstly, I think the main purpose of today's forum itself is to see, can a company bootstrap itself to IPO? If so, what is required to achieve that? And I'll spend most of my time in the next 6-7 minutes focusing on that. And then secondly, if there is time, I'd like to address those two issues, the other 2 points, or if not, maybe during Q&A. Venture capital and private equity itself is becoming borderless. So definitely tech space is an area where borderless capital raising is possible. And point number 3, what can we do to catalyze the VC space, the private equity space? And I'm not trying to take anything away from CSE by saying that, because if done correctly, if the VC space and the private equity space is catalyzed, in 5 years from now, mark my words, the stock exchange will be inundated with tech IPOs which have scaled up significantly to where they are today, knocking on their doors to permit a listing. So I'll park point number 2 and 3 for the moment and just focus on point number 1. So looking at the popular names we hear in terms of IPOs, be it Facebook, Google, Alibaba, Uber, Twitter, Snapchat, on average, they've toiled 5 to 10 years, focusing on the first table on the top of your screen. 5, 10, maybe even sometimes 12, 13 years, worked hard through multiple rounds of fundings to get to their big IPO bell ringing ceremony, which, I mean, we see all the fancy valuations and the nice transactions, but there's been a lot, probably a decade long hard work behind that. And if you look at the VC funding versus IPO funding, sometimes VC has dominated because of the availability of ample funding in those countries. And then looking at the minority companies that were largely bootstrapped, why I use the word largely is that some of these companies may have permitted pre-IPO funding rounds, but largely came to the IPO market without significant external investments, starting from the likes of Microsoft to Dell to Oracle, SAP. So it's not impossible, but it's the minority. Now, what can companies in Sri Lanka do? I mean, if you have attracted multiple rounds of funding, gotten their expertise scaled up, and you're IPO ready, all the better. But if you're in that minority where, because of the lack of capital flows into the tech sector, if you are to bootstrap yourself into being IPO worthy, what do investors expect? So I've tried to summarize and boil it down to 4 main points. Firstly, there needs to be a clearly defined market position. What are you after? What's your addressable market? How large it is, and how scalable your business is, and a clear and achievable plan, business plan, strategic goals of how you get to where you want to be. Point number 2, the business model itself has to be attractive and has to make sense. There needs to be healthy financial returns, of course, not immediately, but at least a path to healthy, sustainable financial returns. And this has to be well articulated when it comes to the forecasts and getting that message across to the investors through the various forums and investor presentations, roadshows that we do. Point number 3, skilled, experienced and proven management team. Being focused and committed is very important. To come into an IPO and say that this is one company that I do and I have some other businesses as well running on the side, which are not part of the listed entity, where your 100% commitment and focus is not with that company, would be a big turnoff. So you need to be, as a promoter, as an entrepreneur, you need to be fully engaged with and committed to this business venture. And fourthly, governance is very important. Especially, governance is important in all companies, especially for tech IPOs, because you don't have a lot of hard assets that the investors can have as a fallback in the event everything turns out bad. You're essentially depending on the plan, the strategy, and the thoughts, ideas, and knowledge of the entrepreneur. So governance needs to be there, not just in terms of ticking the box as far as SEC, CSE rules are concerned, but in terms of meeting those requirements in spirit, so that at IPO time, investors out there would sit at the table and have the same risks and reward structures that the entrepreneurs, the promoters of the company would enjoy. So that's essentially a summary of what would be required from an investor point of view, certain things that we look as part of our business due diligence when taking in a company IPO. So what's the investment banker's role? Point number one, business due diligence. And essentially what we do is trying to see if those key attributes are there. Again, we are not experts. We are thinking from a investor point of view, looking at the basically wearing the financial hat. So the entrepreneurs will have to work together with the bank to make sure their plans, their forecast, their projections, their ambitions with this company are very well reflected in the communications to the market. Structuring and valuations, that's an important part. I'm sure we'll have a lot of questions on that, which will come address during Q&A. Number three, documentation. So there's a IPO prospectus where legal input is required. There's marketing and roadshow presentations, regulatory filings, and then working with stock exchange, SEC if required to secure regulatory approval. Then the all-important distribution and placement phase, a targeted strategy based on our business model, based on what the company is doing. Do we go retail? Do we target institutional? What mix of that? So that's part of the distribution and placement strategy, and execution, of course, is very important. And then finally, transaction closure. So I'll end it at that, and just let me take 2 minutes to quickly pick up on the 2 points that I parked at the end, at the beginning. Apart from bootstrapping yourself to IPO, point number two, companies that have good products, platforms, services. Right now, we are seeing the borders that usually govern capital raising falling apart. I mean, I know of startups who have really made pitches to Sequoia Capital and some big names in Southeast Asia, in the Far East. So little by little, you're seeing these borders come apart, and companies are reaching out to big investor names. Of course, scale always is a problem as Sri Lankan companies, but at least the trend is positive. So attracting VC money, attracting private equity money or angels overseas can help these companies scale up, because sometimes what you have as an entrepreneur probably is an uncut diamond, and maybe public markets wouldn't see the real diamond and the value within that entity. But definitely the right angel investor or VC or private equity might help polish the diamond and really unlock that value. Point number three, what do we do to catalyze more capital flows into private equity, into venture capital? And this is where I'd like to invite FITIS and ICTA. When it comes to policy making, if there can be certain incentives given for capital flows that are coming into private equity funds or venture capital, angel investing, because there may have to be some incentives, at least at the start, to catalyze these capital flows. And these capital flows will not only create IPO-able companies, a whole heap of them 5 years, 6 years down the line, but also energize these ISMEs, our SME sector. And technology is an area where you can have an extremely a big impact to the economy. You can scale up easily across borders. You can be in Sri Lanka and be selling to the global audience. There's a lot of employment creation. So I think that's an area that, as an industry, there should be some focus in terms of lobbying for private capital flows into this area, in terms of providing incentives for investments in tech companies and maybe SMEs in a broader sense. So that brings essentially what I wanted to speak on to an end, and we'll probably take questions during Q&A.
Thank you, Nilendra, taking us through the role of the investment bank. I think we have covered of a tech company in the journey of listing in the public market, the capital market. But having said that, we also would like to, we also have the Sulfa, who is the founder and the CEO of PICME, to get his views as a potential issuer. In fact, today, incidentally, I saw a press release about how IFEC has infused the capital for PICME. And so I'm sure it is a tech company or a company which use technology heavily as a digital platforms to conduct your businesses, and within a very short period of time, you have thinking of perhaps maybe listing in the stock market. So may I ask Sulfa to share your thoughts in this journey? Where are you, and what are the challenges that you are facing, and how could the regulators or the government or anyone could help you in this process? Over to you, Sulfa.
Sure. Yeah, thank you, Aruna. Thank you so much. Thank you for having me. I hope you can hear me well.
Yes.
So I think, yeah. So I think I'm actually very grateful to be here. This is obviously a big thank you for FITIS for organizing this. I think I just want to reflect on an entrepreneur journey, right? And how it sort of these new regulations, how it sort of helps an entrepreneur, because finally entrepreneurs are the one that makes the country evolve, right? So I think when I sort of raised my first round of capital, my angel round, and I actually went back to my deck to see what I pitched there. I think the most important thing in a deck is obviously the business, right? And that's what the investor is interested in looking at. What does the business do, and what kind of revenues can it make? But always it ends with what is the exit, right? Every investor wants to know, okay, if I put $1 million into this business or $1 million into this business, how can I exit this money? How do I exit from this business, right? And generally, as Nilendra says, venture capital is, in this present age, companies stay private as much as possible. You saw that in average last year was about 10 years. So I think so investors look at what the exit options are, and I can tell you in my investment deck, CSE was not one of them, right? So it was more of an M&A or a buyout, something to that effect, right? But I'm now happy that at least I have that exit as well, right? So I think for any entrepreneur out there, when you do your pitch deck, you have to say, how is the investor going to make his money, and having the option of saying, I have an exit plan. I could exit through Colombo Stock Exchange is a very powerful thing, right? And I knew, CSE had very strict guidelines before. It would not be possible for a tech company to get listed at that time. But I think I'm very grateful. I think the company is grateful. The shareholders are grateful that CSE has relaxed these requirements, and tech companies like us now can possibly list. Yeah, I think so. That being said, this is the best time to become an entrepreneur, right? I think this is a great entrepreneurial age, right? Any young entrepreneur out there, you pick the right profession, if I may put it that way, to be an entrepreneur, and there's no better time to be an entrepreneur than this, because obviously the kind of wealth that can be made and the kind of opportunities that are available now. And we are in this new industrial revolution, right? Things, every business is rewritten again, right? So I think having options like CSC available for you is going to be a big plus. In fact, like Aruna said, we closed our Series B about a few weeks ago, right? And I can tell you that, for example, if having options as CS as going public in Sri Lanka are going to help more venture capitalists and investors to come to Sri Lanka, right? And I think that's going to be a big plus for the startup ecosystem in the country. And I think as companies like us exit in public markets or go into public markets, we will see more and more companies coming out. At the same time, there'll be more and more venture capitalists and private investors coming into this area. So I think all in all, these are good times ahead of us, and I'm looking forward to working with CSC and the rest of the other stakeholders in this ecosystem to go through this journey. It's the first time for me as well, like Nilendra sort of showed the evolution of companies. I think going public is like a marriage, right? You have a kid who grows up, from teenage age, you come to a certain level, but obviously it doesn't end there. After marriage, you need to live your normal, you got to live on your own and grow up from there. So there's obviously interesting times ahead of us, and we are keen to see how we can get there. Over to you, Aruna.
Right. Okay, Sulfada. So thank you very much for sharing your thoughts, and I think those thoughts are very useful and encouraging for all the tech companies to look at it. So having said that, let me raise few questions, particularly I think to Nilendra. Now, Nilendra, I think in the Rajiv's presentation also he did mention about there are 600 IT companies in Sri Lanka, but if you really look at out of the 600 companies, I'm sure 70% of them are the software developed companies. Now, when it's come to the software developed companies, I think their main asset or their main product is the software. And then so when it's come to the software development companies, we use the software as their intellectual property. But if you really look at in Sri Lanka, the intellectual property and then the getting patent are very difficult. So do you think in that context, these intellectual property be valued, and that can those be added as asset class in the balance sheet when it's come to the listing? And how would you sort of look at it? Because this is very critical, because most of the companies, software companies, the main accessory, the intellectual property, the software. Yes. How would you value this? Yes.
Yeah. Thanks, Aruna. So I think there are two facets to your question. One is if you have a software product that has been developed, does it get recognized on the balance sheet? One. The other facet that I would take out of it is, would investors pay for it? On point number one, I'm not an auditor, but my understanding of financial reporting standards basically is that if you develop something in-house, unfortunately, the present accounting regulations does not allow that to be capitalized. But if you do acquire, if there is a purchase consideration attributed to it, then that can be recognized on the books, and then there'll be the test of impairment and amortization coming in. So that's the accounting side of it, which I'm not fully qualified to answer, but that's my 2 cents on that. The more important facet of the question is, do investors pay for it? Can you value it? How do you value it in a capital raise or in an IPO for that matter? Now, I would like to say that there are different schools of thought, but I'm a firm believer that if you have a software product, if you have something that is monetizable, and you're not in the business of developing products and selling, but rather monetizing it via getting a user base, subscription model, or outright sale, whatever that business model may be, it has to get reflected in cash flows. And this may not be immediate cash flows because certain products might be R&D intensive, might take various test periods to launch it into the market, to have acceptance, and then scale up. But at least if you're going public, I would say at least within a 4 to 5 year horizon, we need to see a credible path to monetization for cash flows being generated. But of course, like I said, in that venture lifecycle diagram, you may have a POC or a concept or an idea in your mind where you go to an angel investor, and that angel investor probably definitely might be much more open to work with you, refine it, maybe without seeing a profit or a cash flow or a revenue coming in, for a couple of years maybe, or more than that. So that's where the different risks and rewards really kick in. So if my view is that to answer your question, if you're going public, I think you need to, at least in the long run, demonstrate how your intellectual property asset, be it people, be it ideas, be it a software product, generates revenues, generates cash flows, and how ultimately people are investing with you to get a return, to get cash flows, either by way of dividends or capital gains. So that needs to be demonstrated.
Right. Okay, Nilinda. So the next question probably I will have is towards the Renuka. Now that probably most of the software companies has to look at the future cash flows in terms of sort of deciding the listing it. Would the current regulations will help? As Nilendra said, the important aspect is the future cash flows and generating the revenue. Would that help with the new regulations? How would you look at it?
Yes, it would, because initially cash flows were not recognized. You had to have a 3-year consecutive profit record. Otherwise, you can't come in. We had situations where certain conglomerates couldn't get into the main board because they didn't have 3-year profit record. So now with this new 2 options coming in, the revenue test, if you generate enough revenue, plus if you have a sizable market cap, you can get into the main board. Or even Dirisavi, only using your revenue, strength of your revenue. Then the cash flows, yes, we have not given a amount to cash flows. If you generate enough cash flows for the positive, basically operating cash flows for the last 2 financial years, coupled with the market cap of 5 billion, you can list on the main board, which was not there earlier. Now that's the difference. So the new listing rules will definitely facilitate the listing of those companies who don't necessarily have a profit record. Now you take globally, Uber. My understanding is they don't have a profit record. Now, hypothetically, if they had come to Colombo Stock Exchange, we wouldn't have been able to list them on the main board. It was like that. So now that deficiency no longer exists.
Right. Can I put this question to Zulfa? Looking at the new rules and looking at the new rules, how confident are you as a founder of a tech companies to go on the listing?
I think the changes are positive. Obviously, we haven't yet begun the journey. Obviously, that journey needs to start. We are looking at it in a very positive way as a company, and we want to see. My responsibility as a CEO is to provide my shareholders an exit. So going public is certainly a strong option.
All right. Okay. So there's a question which has got.
If I may, but there's another aspect to these tech companies and startups, because their business models are pretty much based on human aspect rather than asset. It's more about human knowledge, software, etc., than assets. They don't own assets, not necessarily. So the new rules actually cater to that. That's the difference. So that we need to sort of highlight here.
Yeah. Okay. Thanks. I would like to pose a question which has come on the the chat box. Other than the question is, other than the regulatory approval process that you just discussed, will the CSC also play a role in encouraging the industry regulation applicable to tech companies in Sri Lanka, which would be an encouragement to investor to invest in tech companies, as well as the tech companies like companies to list like the IPs and privacy, etc. Rajiv, or would you like to respond to that?
Yeah, we may not be able to directly influence a certain policy level with regard to tech company, but I think here the partnership that we are forging with ICTA will become important, Aruna, for this reason. So that, in fact, what we did discuss in terms of partnership, and hopefully will end up with a MOU with the ICTA, is to address any issues contained in the tech sector, so that as an exchange we could respond better to the needs and aspirations of the tech companies in the ICTA sector, in the tech sector. So I think through that partnership, we certainly can work together with ICTA and other agencies to see whether some policy level changes, if required, can be done. So if there are any suggestions and changes, we most welcome. We are open to receiving those, so that we can take this discussion together with them.
Sure. Rajesh, I mean, from a FITIS perspective, I think is one of our key agenda is to support our members in terms of getting their IPs. In fact, we have a separate committee. We are trying to work on that because we see that the IP and the patent rights are very important for our local companies to go global. So that they'll create a lot of recognition, and as a result, they should be able to look at, going public. Is some of the things
Aruna, if I were to interrupt, I think I know the Jayanta is still on. This question is also about privacy and data protection, and I'm sure Jayanta and team are working on a data protection law, which is going to come in. So
yes,
that will help too.
Yeah. So I believe probably your view is that the data protection laws also will help in the process of the public listing, especially for the tech companies. Having said that, I have another question for Nilendra. Now, one of the things that most of the companies, tech companies, the one consideration is that when it's come to the listing, the stability, the regional and the local stability, because you need to ensure that the investors look at this positively. How do you look at that aspect, especially the political stability, and the local stability, etc.? Because if you look at other countries, the companies that the tech companies that you have listed are in those countries, the regional and their political stability is very high. But whereas we have some of course, I think we are looking forward to that stability. How do you look at that, and what advice would you give?
Right. So Aruna, I think there are two sides to that question. Again, one is the political stability part of it, and then secondly, the policy certainty. I mean, from a political stability point of view, we all know what happened over the last 6 months. I think we have now a government that is as stable gets. So box ticked. Point number two, policy certainty is something that over a long period of time we haven't had, and that's where I think FITIS, ICTA, everyone can play a role. If there is a clear policy framework mapped out as to how tech companies are supported, as to how they are preferred when it comes to local IT product services procurement, as to how they are supported, that'll really create the new breed of entrepreneurs in this country. And let me tie that back into one of the points that I mentioned during my presentation. I think there is some really good work being done by ICTA in terms of some of the items you mentioned, data protection, privacy laws, all of that. But I believe a big missing piece is capital. And again, I reiterate, I'm not taking anything away from the Colombo Stock Exchange. If we can get our policymakers to adequately incentivize private capital flows into private equity, into VC. I mean, Zulfa is a great success story, nothing to take away from him. He's a case study of how you've gone through multiple funding rounds. Rajiva mentioned there are 600 out there. Hopefully, if they're adequately funded, we might have 60 Zulfas knocking on the doors of Colombo Stock Exchange wanting to list. And these are highly scalable, highly good business models, companies in 5 years that are ready to list. So I think that's a very important piece that needs to happen, that incentivization for private capital flows, because it's always easy to make investors a scapegoat. People say, look at the US, look at the multiples they are paying on sales. Almost right now, S&P 500 tech companies are trading at about 5 or 6 times sales, not earnings, sales. In Sri Lanka, we are at, I don't know, 5-6 times earnings some big companies are trading at. So it's easy to blame the investors, but if you really look at it, the underlying factor is that we haven't seen growth and consistency for a prolonged period of time where people become so risk averse. And when you're risk averse, when you're invested in a fixed income portfolio with the kind of rate volatility we have, people make significant capital gains just staying in the most risk-free of instruments, treasury bonds, because that's the kind of rate volatility we have. That's just an indicator that the entire system is not set up in a way where risk is rewarded and encouraged. So policy certainty will definitely help that. Maybe a little bit of incentives to kickstart private capital flows into private equity, VC will definitely, create this snowball effect, not just for tech companies to list on the IPO, but in terms of creating employment, in terms of adding value to the economy, in terms of going beyond borders, in terms of taking Sri Lankan companies into the global arena.
Nilendra, just maybe the question maybe I have is probably you explain, but if you request now that the CSE has come up with the new rules, and then the digital transformation within the country, and you're looking at more closely the tech companies, and then the banks are quite interested. Having said that, if you tell what should be the role of the government, if you list it out 1, 2, 3, what are the things the government should be doing it? What are the things that the industry, we as an industry body, we should be doing in this process? What is the role of the ICTA, or what is the role of the other banks should be doing it? If you list it out, can you mention a few points so that it will become much more sort of a takeaway points, and then some of the things that that we can take it forward, some of the things that the CSE can take it, some of the things that the ICTA can take it forward. Now that the ICTA representative also sitting in the CSE, I think all those things will become much easier in terms of the implementation, because sometimes we have a lot of ideas but won't implement it. So if you mention the few things, what is the role of the government at this stage? What should the industry should be doing? What is the ICTA's role? What is the CSE's role? Well, how do you respond?
Okay, so I basically had probably about a minute to put 3 points together, which is the duration of your question. So maybe this can be refined further, but off the top of my head, I would say A, education, B, policy and policy certainty, and C, capital. To elaborate, A, I mean, from a economy point of view, the tech space, software products, services, this is an area that we have talent. I mean, Rajiva mentioned about 600 companies. We have immense talent, and I know it because I'm coming from a background of computer science and engineering. So if there can be significant capacity building in terms of education, and I know the present government is focusing on that in a big way, and I think that needs to get on the single most important agenda, because this is an area that we as a country, we can't, I mean, there are certain industries where we can't compete in, which is a fact, but this is an industry that it's borderless. You can just, working out of a garage or a basement in this country, you can just build the next tech service or product company that might, be very popular in the world. So education focusing, I think there's a big focus on technology, engineering, science streams as opposed to some of the ordinary or the traditionally focused areas. So education is extremely important. B, policy consistency. If there is a local entrepreneur or local tech company preferred policy in procurement, because I mean, there's a lot of procurement that's happening within the government sector where there can be critical mass given to our companies, our tech companies, our smaller companies, our entrepreneurs to scale up and learn and then maybe venture into the global space. So that's very important in terms of procurement, in terms of what incentives are given, and having that clarity over a longer period of time. That's the most important thing. And thirdly, capital. I'm pretty sure there are plenty of good ideas, solid business models that are not even seeing the light of day and falling, on that path just because they didn't have capital. So providing that capital is important, and banks are not the answer. I repeat, banks are not the answer to provide that capital. Banks are not in the business of private equity. And I'm not asking government to provide that private equity as well. Maybe that's a business left with the private sector. Incentivize private sector. There is ample capital pools within the private sector. If that money is incentivized and comes into financing, maybe broad SMEs, maybe special incentives for tech companies, because those are highly scalable. As I said, I mean, they can go from 1 employee to 100 in maybe a couple of years, maybe 1,000 in 3-4 years. And there are a lot of success stories that have happened like that. So incentivizing private capital to fund this industry, the tech space, is the third alternative, the policy priority that I would highlight.
Sure. Thank you, Nirendra. So having listened to you, the Rajiva, I have a question. Now, perhaps the end of the day, I think these encouraging tech companies, getting them to list may be a part of the CSC plan. So do you think you will have a cohesive plan where until up to you get few tech companies to list, will you have a plan within the CSC, and then that you will sort of spearhead that plan until, you may have to influence the government, you may have to influence the, other institution, and you have to work with the, bodies like the Federation, the ICTA, etc. Do you think you will have a plan like that from the stock exchange point of view?
Yeah, Arun, I would put it in this manner. I think picking up from what Nirendra left off, we would, as an exchange, encourage the development of venture capital, encourage the development of private equity, because as he quite rightly said, this listing is a journey. And I think the entire ecosystem has to be developed. We can't do things in isolation. So like we are amending our rules, we are coming up with better, more options for companies to go public. I think the part that comes before, in terms of angel investors, in terms of private equity, in terms of venture capital companies, that entire area also has to be developed, incentivized, quite rightly, as Nirendra said, and those will finally flow into public markets. So I think that entire product offering, if I put it that way, has to be given to the tech sector in order to incentivize. We all agree that technology is the future. We are nurturing technology, particularly if you look at the government's policy initiatives. It's all about incentivizing, digitizing tech companies, going digital, etc. So I think there's a great future ahead of us in terms of the IT sector. A lot of probably resources and funding will go in there. So it's important that the policy level work also has to be done in equal pace, if I would put it that way, with the developments taking place maybe at the exchange and some other companies as well. Somebody did mention about the Data Protection Act. Yes, I think, as I said, ICTA and Jayant and them are working on it, and that's an important bit of legislation that will come in, which will help tech companies, particularly if they have intention of going public, etc., and any other incentives that could be identified that can be brought in. So I don't know if I put it, it's a part of a broader plan that we would have. It's not that the exchange can go in isolation and get so many tech companies listed. So if you are really keen to get the big tech companies in first, there has to be a cohesive program of work that is done. And I think the partnerships that we are building with FITIS, for example, with ICTA, is going to be pretty important in that direction, because we can also help to drive policy incentives that we spoke about. So that's the plan of action, quite apart from whatever changes we have done. So I don't know, it's a kind of collaborative effort that we are trying to make together with the industry as well as the policy makers to make this happen. So it's a journey. We are not looking at a quick win of a 6 months to 1 year period, but it's a journey, and it's, I think, a long-term journey that we're looking at.
Yeah, sure. Thank you. There's a question which has come to Nilendra. Should the government protect local companies from cash dumping and unethical behavior by well-funded foreign companies?
I seem to be getting more of the policy questions than I mean, see, protectionism is a choice, whether you be completely liberal or protecting your company. Always there'll be arguments both for and against each other. But if you do see an industry which you think as a country we can have an advantage, that we can scale up, that we can build employment, that we can make into a significant contributor to our GDP, I would say that should be protected. And that's where, rather than restricting others, which is a more negative way to go about it, maybe preferring the local company might be a more positive approach to achieve the same goal. So like I said, government IT procurement may be preferred, local software developers, platform developers, maybe product services, all of that. So I'm sure some of these are already existent, and please don't misunderstand my if I'm ignorant on some of the measures that are already in place. But what I'm saying is we need to have that favoration probably as a means of protectionism for maybe the tech space, which we can, with the right incentives, promote to be a significant employer and a significant contributor to the economy.
Right. Okay. Thank you. Just there's one more question. I'll take maybe two questions, and then before we conclude, Renuka, now when the tech companies, I mean, this is looking at the policy and then looking at the future. If the tech companies are going to be listed, do you think the corporate governance code should be amended to consider the digital transformation or these tech companies? How would you look at it?
Okay, now I would look at it like this. Now, just like any other startup, the tech companies also go through a period of evolution, right? It has to evolve from where it is to be in a position of listing. Now, not only corporate governance, many other factors like different business requirements, different what sort of stakeholders, shareholders you should have, varying compliance levels, and various other business practices would depend on what stage you are. So it may not necessarily, now corporate governance also, like all the other requirements, has to evolve. Now, if the company is at the inception level, I personally don't think corporate governance requirements matter that much, because then at that stage the company is struggling to come up. Everything is uncertain. You are trying to get some investors. Basically, if you can conduct your business legally and basically have a very straightforward check the box sort of approach, you will be okay at that stage. But then as you evolve during the early stage of investment, now for example, if you start getting angel investors and venture capital, then that is the time, in my personal view, you should start looking at good governance practices, right? because that's what investors would look for. Most sophisticated investors, so institutional investors would look for that. Then the third stage is the private equity and strategic investments. I think it will be absolutely necessary if you have some level of governance, chairman and CEO split and various other committees. So you need to have a proper business plan, maybe internal policies, all that. Everything is part of the governance. Then comes the listing part of it at the last stage. And it's a given that you must have good corporate governance practices there. So this what I explained applies to every startup which is going to evolve to the point of listing. Same applies to tech companies. In terms of tech companies per se, I'm not entirely sure whether there's additional corporate governance requirements that are necessary. The same framework will apply if you it depends on where you list. If you list on the main segment, yes, the corporate governance framework will apply. And if you list on the on the Empower board, for example, we have this new board for SME sector. Slightly different corporate governance requirements are there. So if you want me to explain, I can explain that. But from a tech company's point of view, I don't know. Maybe other panelists could fill in here. Maybe information the security of your information, data protection, security can be a responsibility given to the board. Right now, I don't know whether it's happening. Every company does that, but because you're in a tech company, the entire business model revolves around IT technology. Yeah. So I think it's essential that board takes the responsibility to protect information security, data protection. I think that can be an added thing for a tech company, which may not necessarily be the case for other companies. So other than that, I'm not very sure whether there should be any other specific corporate governance practices that should be assigned to a tech company. In any case, I think now see the corporate governance practices, you must understand now the listing rules has corporate governance requirements. Then there's this code, which is developed by the SEC with the CS Sri Lanka, which is a voluntary code. Now both these things are being reviewed at the moment. So maybe we could, it's just that we don't have this, we don't even have a single company on the Empower board. So we could definitely look at it. Broad answer to your question should be if a company is at this knocking on the listing door. For example, if your next stage is to get a listing, I think you need to have proper corporate governance practices because it's going to help getting more investors in the IPO and subsequent to listing. Other companies, I think it's more like a evolving process.
Okay, thanks, Nilendra. So maybe finally, let me ask few questions put forward to Nilendra and then Rajiva. Now, if a tech company is in the process of considering the listing, what is that company should build a story? Good story must build it. How would you advise the company? And that is a question for you, Nilendra. And then I would like to ask another question from the Rajiva, put forward to Rajiva. These who are the financial advisors available for a new software company to get advice on the IPO? Nilendra, over to you. Maybe you can answer.
Right. Thanks, Aruna. So to take that question directed to me, so I think essentially what happens during that first phase of our engagement of any investment bank being engaged with a potential IPO client, what we broadly call as business due diligence, IPO structuring, is to be comfortable as an investment bank that the business model is healthy, is sustainable, that there is a path to profitability, especially for the tech sector. If there is no profitability right now, that there is a clear strategic plan which we can take and market to investors, both institutional and retail, and then broadly what we refer to as the IPO story. So the IPO story is what is the company doing and how are you doing it better than the others, and what attributes do you have that make this company able to grow, able to sustain itself, and able to give solid, healthy financial returns at some point to its investors. So So putting this together, I mean, it's a mix of an art and a science. Science part will be the numbers part, crunching the numbers, forecasting, sizing up the market, seeing what sort of market shares can be reasonably achieved, and based on that, what sort of cash flows, profitabilities, revenues can be generated. So that's the scientific part of it. And the artistic part of it is, I mean, ultimately, what need are you serving? What need are you serving? And why do you think you can sustain as a company? So weaving this together essentially will give you your IPO story, and that's an area that I would say is not very much highlighted, but is extremely essential in the overall IPO process, because how you put your story together and how you relate it to the market, to your investors, will basically be the make or break of a successful IPO.
Yeah, if I take the other question that you asked, Aruna, I think the answer is that there are, in this space, in the IPO space, it's best that you reach out to an investment bank. They are the best placed to give you that complete advice as regards to this entire process of going public, including advice as to how do you structure your company, how do you prepare yourself for a listing, the timing of the issue, the marketing of the issue, the pricing, the valuations, and all of that. And so we have about up to about 10 companies that offer some very good investment banks that can offer you this advice. So if you can, who is interested can get in touch with us. We certainly will share the list with you.
Sure. So Rajiv, before we conclude, now sort of we have explained the journey and also the challenges, and then the support that each party can give. What would be our next step if a company is interested in listing?
Yeah, I think
what would they do?
I think Aruna is best is to reach out to us, and you want to take it to the next level. I think there is a one-to-one discussion or a direct one-to-one discussion that will be necessary, and our team, Renuka and his team, will be more than willing to meet any company, and thereafter they can assess the suitability and how ready the company is, and then that company can take that step to then meet their financial advances and advisors and so on. So I think those who are interested could take the next step of calling us and expressing your interest to meet us, and we probably can have a series of meetings thereafter.
Sure. I think at the very beginning, us also mentioned that the FITIS would like to sort of facilitate this process. So if anyone is interested, please get in touch with us so that we also can facilitate the process. Sorry, someone was trying to say something. Yeah.
Aruna, just to add to what Rajiv said.
Yes.
Now, from the point of an issuer, if they are pretty seriously considering a listing, a couple of other factors that they might need to consider is basically they need to have a strategic vision, and they will have to figure out how a listing would fit in that journey. That's a very key thing. You need to have because you don't just list for the sake of listing, right? There has to be a strategy, either for the current promoters to exit. I mean, that could be various things, because a listing would generate long-term capital, right? And there are segments of investors who are willing to take that risk. Okay, they need a return which is higher than the cost of their capital, so that's why they're investing. So there is a segment of investors who will always come in. So the company will have to figure out whether the long-term strategy of the company would be in line with a listing. That's the primary thing. Then the internal readiness of the management, because the whole culture can change thereafter. The systems, the level of compliance, maybe the kind of advisors they have. So all that they need to be prepared. And one of the most important thing is, even after deciding to go for an IPO, they have to come up with a very good investment case, because people are not going to just buy in for any investment case. So it has to be a solid objective or a series of objectives. So that has to also to be figured out. And there are certain other things you might have to do, internal restructuring and various eliminating all the unprofitable ventures. That some level of housekeeping has to be done with the advice given by the investment bank. So those are some of the things that I could add on in this whole journey.
Right. Just a question that came into my mind. Is there a sort of guidance, the book or something developed in relation to this?
There is. I think it's on our website, but we could. There is a guide to get a listing. There used to be one. I'm not entirely
Yeah,
sure.
there's a booklet that
That's right. Yes,
you can provide. Yeah,
it's on the website. Yeah.
Yeah. Could that be sort of customized to the tech companies? So is something that we can do jointly?
Yeah.
Is there anything?
That's possible. Yeah.
That's
By and
possible.
large, generally the book will apply to any potential issue, but I think we can look at IT specific matters also.
Absolutely. Yeah. I think, yeah, something that will, I'm sure you will useful. Right. So having said that, let me conclude. And first of all, I would like to thank all our the speakers and the panelists who joined with us today. Rajiva Bandaranayaka, CEO of the CSC, and then Renuka Vijayawardena, Chief Regulatory Officer of Colombo Stock Exchange. Then we had Nilendra Veerasinghe, Head of Corporate Advisory at NDB Investment Bank. And also we are thankful to Jeffrey Zulfa, founder and the CEO of PICME. And also I would like to thank the ICTA, Jayanta, Sachindra, and initiating this. And also I would like to thank all our partners, our event partner, platform partner, messaging partner, and our press, and also supporting partners as well as the corporate partners. So with that, we will conclude the session. And I thank all those who attended. And if there's anything that please do get in touch with us. And as a federation, we would like to help all our members and the tech companies to go to the next level. With that, thank you very much and good night.
Thank you, everyone.
Thank you.
Thanks.